So if you're an investor and you're looking for a cheap stock will typically be, if the number one thing I would say you need to look for on a company's balance sheet, or if you're trying to look for a cheap company, is the net asset value. So, or you could argue, well, if you look at the net asset value, it's similar to the price to book ratio, but the net asset value is what you need to look for. The acronym is NAV or NAV. It's the net asset value is basically the total assets minus plus total liabilities. So liabilities are debt that the company owes, and then you get the figure, and then that's pretty much the net asset value or the total shareholders' equity. If you do that, if you get that number and you divide it by the shares outstanding, so however many shares that the company has, then you get the actual intrinsic value and price per share. There's a guy called Benjamin Graham who has a different type of way to find cheap stocks. He does the net current assets. So he looks at the net current assets. So net current assets are, or current assets are, the assets that the company has that can be liquidated or turned into cash within the next 12 months. So when you get that figure, you divide it by the share price. Also, you minus you minus the liabilities as well. So you get the total shareholders equity, but it's not the overall shareholders equity. It's the net current assets of as a ratio. So instead of looking at the overall assets, long-term assets as well as short-term assets, you look at just the short-term net. You just look at the current assets. So whatever assets can be liquidated within the next 12 months, and you divide it by the shares outstanding, and then you get the figure. And then that's a better way to find a cheaper company, because it looks at if you were to liquidate the company or turn it into cash within the next 12 months, then that's the figure you'll get. And you'll get a lower figure with that one, but then you'll be able to narrow the scope of finding cheap companies that way.